Hi, everyone, and welcome back to the Finance Zone. When stocks across a sector or across the market are down sharply, it's sometimes hard to point to the single factor driving the sell off. I think there are a few contributing factors here. Shares of NYSE, China's premium electric vehicle maker, blew the doors off of 2020. Beginning the year at $4, NIO stock shot up like a rocket through the year end, finishing 2020 at $50. Market down is one of the best years of any stock has had in recent memory. There are two prices that are critical for any investor to know: the current price of the investment that they own or plan to own, and its future selling price. Despite this, investors are constantly reviewing past pricing history and using it to influence their future investment decisions. But stocks don't go up in straight lines. After a red-hot start to 2021, NIO has since trended lower, losing more than 30% of its value over the past 3 weeks, thanks to general fear in the market about rapidly rising interest rates. Today we're going to be talking about NIO stock predictions. Make sure to stay till the end to learn about this amazing stock updates. First, the $1.9 trillion COVID-19 relief package moving through the U.S. Congress has some economists and investors worried about inflation simply because it's a lot of money to dump into the economy. That's almost certainly having an effect. Second, and likely related, the rate on the benchmark 10-year U.S. Treasury bond has risen to 1.37%. That's still quite low by historical standards, but it hasn't been that high since early 2020. Generally speaking, investors tend to reduce risk exposure when interest rates are rising. This recent weakness in NIO is an opportunity, and the time to buy might be now. NIO recently provided a strong delivery update, which implies the business momentum continues to ramp. The outlook strongly implies that NIO is positioned to have another breakout year in 2021, and both the fundamentals and technicals strongly support the thesis that NIO is a great buy below $50. NIO stock, overstated fears. The recent rising in interest rates, the 10-year Treasury yield has pushed above 1.3% from 1.1% at the start of the month. Is something to watch closely, but its impact on the market is both ephemeral and overstated. Rates are pushing higher right now because of huge fiscal and monetary stimulus. That inflationary force will continue for the foreseeable future, but it's simultaneously fighting against much bigger, more enduring deflationary forces in automation and globalization. Momentum. Don't fight the tape. The widely quoted piece of stock market wisdom warns investors not to get in the way of market trends. The assumption is that the best bet about market movement is that they'll continue in the same direction. This concept has its roots in behavioral finance. That is, automated technology is capable of replacing millions of jobs today. Think language processing software automating call centers and customer service reps. Think self-checkout kiosks automating cashiers. Think telehealth platforms automating the hospital front desk. Technology has advanced to the point of being ready to replace millions of jobs. At the same time, thanks to COVID-19, more and more enterprises are comfortable with adopting these technologies. The result is that over the next few years, we're going to see a huge and permanent job loss in some sectors of the economy. That's an enormous deflationary force. Equally as powerful is globalization, as the global geopolitical stage is now set for globalization to come back into the spotlight for companies to more aggressively outsource labor and production, which will keep consumer prices low. So yes, the government is spending a bunch of money, but they almost have to spend a ton of money just to keep rates from going negative. Long term, we're stuck in a lower for longer situation when it comes to interest rates. That's important because while higher rates will hurt equity valuations, by numerical analysis of the relationship between interest rates and equity valuations, dating back to the 1980s, found that the 10-year Treasury yield would have to rise 2.5% before it starts to have a meaningful impact on valuations. Newsflash, that isn't going to happen anytime soon. So the recent weakness in the stock market is a buying opportunity, especially in high-quality growth stocks like NIO stock. Experienced investors who have seen many market ups and downs often take the view that the market will even out over time. Historically, high market prices often discourage these investors from investing, while historically low prices may represent an opportunity. The tendency of a variable, such as a stock price, to converge on an average value over time is called mean reversion. The phenomenon has been founded in several economic indicators which are useful to know, including exchange rates, gross domestic product (GDP) growth, interest rates, and unemployment. A mean reversion may be responsible for business cycles. Remember, check the description and use my Webull referral code for 2 free stocks. Strong business update. Ignoring the interest rate noise and turning our attention to NIO's business fundamentals, we see nothing but good things. NIO recently reported January delivery numbers that were nothing short of spectacular. The company delivered 7,225 vehicles last month. That's up 352% year over year, marking NIO's 10th consecutive month of triple-digit growth and its single best year-over-year delivery growth rate. By itself, this 350% delivery growth rate is impressive. But there's another better news. January deliveries rose 3% month over month. That never happens in the auto market. December deliveries are usually enormous thanks to holiday demand as consumers rush to buy new cars for Christmas. Then deliveries almost always fall off a cliff in January, as the jolly times end and the holiday demand dries up. For example, NIO's January 2020 deliveries dropped 50% from December 2019, but NIO bucked this trend in 2021. NIO sales rose from December to January. That strongly speaks to the momentum underlying the business today. Zooming trailing 12-month deliveries now stand just above 49,000, up 13% month-over-month and 143% year-over-year. If stock returns are essentially random, the best prediction for tomorrow's market price is simply today's price, plus a very small increase. Rather than focusing on past trends and looking for possible momentum or mean reversion, investors should instead concentrate on managing the risk inherent in their volatile investments. All in all, it appears that NIO's business isn't just sustaining its robust 2022 momentum, but actually building on it. Things are only getting better here, and the outlook implies that will only continue to get better, which of course implies better days ahead for NIO stock. Robust outlook for 2021. NIO had a strong 2020, no doubt it, but the fundamentals imply that NIO could have even better 2021. China's auto sales struggled in the first half of 2020 thanks to the COVID-19 pandemic. They then rebounded in the second half of the year as pent-up consumer demand coupled with low interest rates. Those two drivers will remain vigorous in 2021 for the first year. China's auto sales are expected to rise 4%. EVs will also be at the epicenter of this rebound in China's auto market. Thanks to government support, increasing supply, falling costs, and shifting consumer demand, China's EV market is expected to grow by an impressive 40% in 2021. NIO will be at the forefront of this booming Chinese EV market. The company just launched a new premium sedan, its fourth EV model. NIO has also just announced a brand new battery that significantly boosts performance specs such as driving range and recharge time. Plus, the company is dramatically improving its battery swapping stations to be far more efficient with much more capacity. In other words, NIO will materially improve its business fundamentals in 2021 at the same time that China's EV market catches fire. That combustion ultimately implies that NIO could have a better year this year than it did last year. Favorable valuation and technicals. On the fundamental side, NIO has a long growth runway ahead of it as the company turns into a globally dominant supplier of premium EVs with a healthy margin profile thanks to falling battery costs and strong pricing power. Long term, I see NIO as the world's second largest EV maker behind only Tesla, TSLA. Our numbers indicate that this reality makes NIO's stock worth at least $60 today and likely somewhere closer to $70, based on the company's earnings potential over the next decade. Indeed, based on that earnings potential, I see NIO racing to $100 in the foreseeable future. Meanwhile, on the technical side, NIO stock is rapidly closing in on its 100-day moving average, $45, a level that the stock has held ever since its big breakout from $4 back in May 2020. Given the company's robust fundamental business momentum and favorable valuation, I don't see NIO breaking below the critical 100-day moving average anytime soon. Even after decades of study by the brightest minds in finance, there are no solid answers. A good conclusion that can be drawn here is that there may be some momentum effects in the short term and a weak mean reversion effect in the long term. The current price is a key component of valuation ratios such as PB and PE that have been shown to have some predictive power on the future returns of a stock. However, these ratios should not be viewed as specific buy and sell signals, but as factors that have been shown to play a role in increasing or reducing the expected long-term return.